Hey everyone, welcome back to Corporate Decoder, the place where we dissect the secret language of big business reports and try not to get bogged down in endless legalese. Get ready because today we're diving into a financial report that is packed with numbers, from fund performance to how much actual money is flowing through this investment vehicle. It is a deep dive into the Columbia-Oregon Intermediate Municipal Bond Fund, and we're going to break down what all those figures really mean for investors. Before we dive in, if you appreciate getting straight insights from tough to red corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below where we break down more filings and discuss investment strategies. So what is the big picture here? This is an annual shareholder report filed with the Securities and Exchange Commission, or SEC. It is essentially a yearly checkup on the financial health and performance of the Columbia-Oregon Intermediate Municipal Bond Fund. Think of it like a report card, but for money managers. The report covers the period from the 1st of August 2024 all the way through the 31st of July 2025. We see details for different classes of shares like Class A, Institutional Class, and others. They all invest in the same underlying assets but have different fee structures, which is super important for how much of your return actually stays in your pocket. One of the first things we look for is how the fund performed and what it cost people to invest. For example, with the class of shares, a hypothetical $10,000 investment faced costs of around $80 for the reporting period. That is less than 1%, but over time, even small percentages add up. Now, let us peek at the actual returns for the class. As shares excluding sales charges, the 1-year return was about 0.82%. Not exactly a rocket ship, but municipal bonds often aim for stability over explosive growth. When you include sales charges, that 1-year return drops to a negative 2.22%. Ouch. That shows how much those initial sales costs can eat into your gains, especially in a flat or down market. Let us compare that to the benchmark index, the Bloomberg 3 to 15-year Blend Municipal Bond Index. It saw a positive 1.86% return over the same year. This tells us that in this particular year, the fund did not keep pace with its benchmark, which is a yellow flag for any investor. The total assets under management for the fund were just over $285 million. That is a decent chunk of change, but it is crucial to see if that number is growing or shrinking over time, as it can impact how the fund is managed. Let's look at where the money is actually invested. The top holdings reveal a strong concentration in Oregon-based entities. We've got Oregon Health and Science University bonds, various City of Portland bonds like water and sewer systems, and Tri-County Metropolitan Transportation District of Oregon. This shows a significant focus on a specific geographic region, which can be a double-edged sword. It might offer local expertise, but it also increases risk if that specific region faces economic trouble. For example, the Oregon Health and Science University, the 1st of July 2034 5.000% bond, is sitting at 2.7% of the fund S net assets. This is a substantial single holding. Diving deeper into the portfolio of investments, we see a massive chunk, nearly 99% of the fund S holdings, in municipal bonds. That is what you'd expect from a municipal bond fund, but it is good to see the exact percentage. Within municipal bonds, we see a breakdown by sector. Airport bonds make up 5.1%. Hospital bonds are a significant 12.3%, and an even larger chunk, 29.9%, is in local general obligation bonds. This diversification within the municipal bond space is good, but that heavy reliance on local government debt in Oregon is still a key thing to watch. If Oregon's economy takes a hit, these bonds could be more vulnerable. The filing also outlines significant risks for investors. They talk about market risk. This means that the value of the fund's investments can go down if the overall stock or bond markets take a dive. This could be due to anything from political events to economic downturns. Then there is interest rate risk. This is a big one for bond funds. If interest rates go up, the value of existing bonds with their lower interest payments usually goes down. The report mentions that longer maturity bonds are more sensitive to these changes. This means if rates rise, the fund's investments could lose value. When it comes to valuing these investments, the report explains their fair value approach. They use a 3-level hierarchy. Level 1 is for investments with quoted prices in active markets, like stocks you can easily buy and sell. Level 2 involves observable inputs, like prices for similar securities or interest rates. Level 3 is for investments where you have to use your own assumptions and judgment because there is not much readily available market data. It sounds like most of their municipal bonds fall into level 2, meaning they revalued based on observable, but not always actively traded inputs. Looking at the statement of assets and liabilities as of the 31st of July 2025, the fund's total assets were over $286 million. Liabilities, which include things like payable for capital shares redeemed and management fees, were around $1.1 million. This leaves net assets of about $285 million. It is good to see that the liabilities are a small fraction of the total assets. The statement of operations for the year ended the 31st of July 2025 shows that the fund earned over $9 million in income, mostly from interest. However, expenses were over $1.6 million after accounting for some fee waivers. This resulted in net investment income of over $7.3 million. On the flip side, the fund experienced a net realized and unrealized loss of over $4.2 million, mainly from changes in the value of their investments. This is why the net increase in net assets from operations was around $3 million for the year, a modest gain. And what about distributions? Shareholders received a total of over $7.3 million in distributions from net investment income and net realized gains. This is how bond funds typically return income to investors. Looking at the financial highlights, the net assets at the end of the reporting period show a slight decrease for some classes compared to the previous year, which aligns with the overall performance. For classes shares, net assets at the end of the period were about $24 million. Institutional class was around $143 million. The Institutional 3 class saw a significant increase in net assets, growing from about $18 million to over $53 million. That is a huge jump, suggesting a lot of new money flowed into that specific share class. It is also important to note that Class S shares only started operations on the 2nd of October, 2024, so their reported returns and portfolio data only cover a portion of the reporting period. This is typical for new share classes. Now, for the big question, what is my take? The report shows a fund that is trying to generate stable income from municipal bonds, with a significant focus on Oregon-based issuers. The performance in the last year was a bit under its benchmark index. The interest rate environment and market risk are clearly stated as major concerns, and rightly so for a bond fund. The good news is the fund is well capitalized with substantial net assets, and they've got mechanisms like fee waivers to help manage expenses. However, the heavy concentration in Oregon municipal debt is a noteworthy risk. If the state faces unexpected financial challenges, this fund could be disproportionately affected compared to a more broadly diversified fund. The fact that some share classes, like Institutional 3, saw massive asset growth suggests strong investor interest, but it is important to understand why that class is so popular, and if that growth is sustainable. Ultimately, this fund seems designed for investors who want exposure to municipal bonds, specifically those in Oregon, and are comfortable with the associated risks of interest rate changes and potential regional economic downturns. It is not a high growth play, but more of an income generator with built-in geographic concentration. Always remember to check the prospectus and understand your own risk tolerance before investing. Alright, that is our breakdown of this comprehensive annual report. What is your take on these numbers and what they signal for the fund? As future, drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into the financial world. Don't forget to check out the Discord in the description for more discussions and direct access to our community. Thanks for watching. See you next time.